Welcome, everyone. My name is Sarah Ray from the Bloomfield Public Library. Thank you for joining us for our fourth part in our virtual banking series with Liberty Bank. Tonight, we're going to be talking about home buying. So I'm going to turn the mic over to you, Rashia.
Thank you, Sarah, and thank you everyone for joining tonight. I really hope that you get something out of this session. Not sure if any of you have participated in any of the last three sessions that we've had. Those were really foundational on building your financial house and getting your financial house in order. So kudos to you if you joined multiple sessions. And again, thank you for joining us this evening. You could be doing anything else, but you decided to be here with us. So I would like this to be very interactive. I have a lot of information to share. I have slides, but feel free at any point if you want to interject and have a question. I'll be sure to stop and make sure I answer because I want you to get the best out of this session as possible. All right. As Sarah mentioned, my name is Rashia Schand. I am one of the affordable loan officers here at Liberty Bank. One of my key roles is obviously helping people finance their homes, but a big part of my role is also education. So I go out and work with community partners to educate our community on the home buying process, which is huge for first-time home buyers. I'm also a wife and mom of four. So if you see a head or two pop in here, just know that the kids are home and they may interrupt. I'm also an author. Being an author, being in the financial literacy world is kind of how I got into this role with Liberty Bank. I have a book called Jumpstart Your Money Journey. It's a financial literacy book for teens and young adults, and it teaches them all the stuff that pretty much wasn't taught in schools and today still not taught in schools as much as it should be. Going over everything that we've covered in this series, but at a younger age where it should start, before kids enter their real world, before they get their first job, the basics of credit, saving, how to invest, why investing is important, why it's important to insure yourself. So I wrote that book for teens and young adults. Now for you guys, we are going to talk about the process of buying a home. So I'm going to share my screen. Can everybody see my screen? And Sarah, I can't see the questions and comments. So if some come through, Can you just let me know?
Yeah, I'll read them out. So we still see the back end of PowerPoint, which is totally fine. We can see your slides.
Do you see the slides? Do you still see the full screen?
Not the full screen, but
okay, let me try to.
We had this issue before with Zooms.
What about now?
No, it's still the same. I'm not sure if you have to stop sharing and try to reshare if it's a separate window or else this also works.
All right, let me just try to stop sharing real quick and.
Okay, good. Yep, full screen. Yep.
All right. So getting ready to buy a home. I think, as we all know, buying a home is a very huge investment. A huge investment of your time for one, searching for a home, but also a big financial investment. And sometimes I feel like people believe that home ownership is out of reach because they don't know all the different programs and opportunities there are for first-time home buyers. So that's where we come in. My team really prides itself on educating the community to make home ownership a reality for a lot of folks. When it comes to getting ready to buy a home, the first step is to decide if you are ready, right? We can look at the economy. We can look at, listen to what other folks are saying or doing. But at the end of the day, decision starts with you. Are you ready to buy a home? The next question is to ask yourself, how much can you afford? And I emphasize how much you can afford, because a lot of times when you're getting pre-qualified for a home, you're getting pre-qualified based off of your current income and the debts that are on your credit, right? Just because you get qualified for a $2,400 mortgage doesn't necessarily mean that you can actually afford that $2,400 mortgage. Why? Because as lenders, we don't factor in your lifestyle. We don't factor in the fact that you have 4 kids and you like to go on vacation, or you like to shop, or you like to give, right? So we're just looking at basic information, how much you make, and the debts that are on your credit report. So you have to ask yourself, how much can I realistically afford? Where do I feel comfortable? How much of a monthly payment will fit into my budget and my lifestyle? Now, once you have an idea of what you can afford, you want to make sure that you check your credit. Before you even go to a loan officer, you want to make sure that you have an idea of what your credit score is. That's like the baseline for every program, every product has a minimum required credit score, right? So you want to make sure that you check your credit score to see where you stand. There's a lot of apps out there that I'm sure everyone is aware of. Credit Karma, Credit Sesame, Experian, all of those are great credit monitoring apps to help you monitor your credit, to see if anything negative pops up, to see how much credit utilization you're using, and to see if you are going in a positive direction or a negative direction. I want to put a caveat out there that when lenders pull your credit score, it's a little different. I get this all the time. People are like, oh, I have a 660. Or they say, my credit score is poor. And they're looking at one credit bureau, whether it's Experian, TransUnion, or Equifax, not realizing when lenders pull your score, we use what we call FICO. And there's different FICO scores as well. And we use your FICO mortgage score. And we pull all 3 scores and we take your mid score. So having a baseline understanding of where you stand is great, but also understand when lenders pull your credit, it might be a little different. Some people are surprised. They think their credit is way worse than it actually is. And then other people are upset because they thought their credit was better than it actually is. So always good to have an app to get a baseline understanding of where you stand, but make sure you just know that your lender will pull your credit. Another thing I get a lot of times when it comes to getting pre-qualified to buy a home, people are hesitant to get their credit pulled. I get it. Nobody wants to sacrifice a couple points just to get your credit pulled, but we have to pull your credit. You can't send us a report that you got from somewhere else, from another lender, from an app. We have to pull your credit. And no, your credit scores are not going to tank, right? If you go around applying for multiple credit cards, then you go apply for an auto loan, then you go apply for a mortgage, yeah, your credit score will drop because you have multiple inquiries. But multiple mortgage inquiries will not hurt you. And we'll talk about shopping around as well, because you want to make sure that you're getting the best loan products. So you may go to 3 different lenders before you choose the lender you want to work with.
Rashia, before you move on from credit, the question in the chat was just, is there a way that we can check our FICO score?
Yes, you can check your FICO score by going to myfico.com. That is one that I recommend because it's closer to your mortgage score. When you go to, again, Experian, you're only getting Experian. I know like Capital One, you can view your score from like their app and stuff, but my FICO is your FICO score. It's not necessarily your mortgage score, but it's as close to as possible. Things like Credit Karma, they use your Vantage score. Think of 2 different companies, right? You got Nissan and Hondas, right? 2 different companies producing 2 different products. So there's 2 different credit reporting agencies that are producing these scores. So they have different models and methodology, and that's why your scores are different. I always tell people your scores are not incorrect. They're just different because they're being used by a different model. All right. So when you're ready to get pre-qualified for a home, you want to connect with a mortgage loan officer. A lot of times people will go to a realtor first, and that's okay. What your realtor is going to do is ask you, have you been pre-qualified? Have you spoken with a lender? How much are you qualified for? And that's where I come into play. That's where mortgage loan officers come into play. We look at your financial picture to help you determine what product is the best for you, and also how much you could afford based on your specific financial makeup. And I want to emphasize that because I work with a lot of borrowers and they may be talking to their cousin, their uncle, their sister, like, oh, they got qualified, but they don't know, or you may not know their full financial makeup. There's three magic numbers that we always look at. It's your credit, it's your assets, and it's your income, right? So you may be in line with somebody else's income, but you don't know what their debt looks like, right? You don't know exactly what their credit score is. So that's why this process is very individualized and every person is going to be different. All right. So your pre-qualification is an estimate of how much money you may be able to borrow. It's not an approval for a loan. What that means is pretty much when I pre-qualify you as a mortgage loan officer, I'm taking your financial documents, I'm looking at all the guidelines of different programs, and I'm running your file through an automated system, and I'm getting an approval, but it's not an official approval because it hasn't been underwritten. And don't worry too much about it, but I just mentioned that because a lot of realtors are sticklers about the terminology. They're like, oh, well, you didn't get a pre-approval. You only got a pre-qualification. So this is not as good as a pre-approval. All it means is it didn't go through underwriting yet. It went through automated underwriting, but an actual underwriter hasn't underwritten your file. And what could happen when an underwriter actually underwrites your file, they may request more documentation or have more questions. All right. So first things first, get that pre-qualification. The documents you need to get pre-qualified, always, again, credit. I'm going to run your credit. All I need is your name, address, and social to figure out where you stand. Next, we're going to cover income, right? So 1 month of pay stubs, your employment history. So just in the system, we'll want to see where do you currently work, how much you currently make, and your history over the last 2 years. You don't have to be at the same job for 2 years, but you do have to have a history of at least working for 2 years. Some loan programs require tax returns. If you're self-employed, we need 2 years of tax returns. And we also need 2 years of W-2s. And again, depending on the program, it's either 2 or 3 years. The third part of the formula, so we got credit, we got income. The third part is assets. So how much do you have saved up? How much do you have a requirement that you can utilize for reserves, right? And that doesn't mean that, some people may think, well, I don't have that much saved up. Maybe I only got $1,000. That's not enough to purchase a home. That's not the case. That's not why we're looking at your assets to determine how much you have, right? When we get your assets, we want to be able to say, okay, based on this is the program that will best suit you. And also, like I said, some programs, if you're buying a multifamily, you're required to have either 3 months or 6 months of reserves, and you can use like a retirement account, a brokerage account to satisfy those reserves. Does not mean you have to touch that money. I know people get afraid, like, oh, I gotta take money out my 401k. That's not the case if it's not needed. And 1 second. I'm sorry. Here. I told you I was going to have some kids popping in, but they're settled now. So, again, credit, income docs, and asset documents are the things that we need to pre-qualify you. And the reason being, we want to figure out how much house you could buy. What can you realistically afford based on your income and your debts? And when I say your debts, it's always the debts that are on your credit report. 1 second. I'm sorry, guys. I'm back. Hopefully, y'all was able to digest some of that information. I know it was a lot. Let me reshare my screen. All right. So, pre-qual documents. Next thing we want to talk about is, I mentioned this earlier. There are so many programs and financing out there. I'm not sure if everybody on here is a first-time home buyer. You don't have to be a first-time home buyer to take advantage of some of these programs, but there are a lot of programs out there for first-time home buyers that offer down payment assistance. Liberty Bank has a great product where we offer 100% financing, and you don't have to put anything down. So, and that program is not just for first-time home buyers. So there's a lot of programs out there. Liberty Bank just received an award for through CHAPA. I'm not sure if anybody's familiar with CHAPA. It's a huge organization in Connecticut that offers down payment assistance and grants and different programs to help home ownership become affordable and achievable. For Connecticut residents. And we just got awarded one of the top lenders that allows multiple subordinations. And when I say subordination, meaning if they have a program, someone can use it. If Liberty Bank has 3 other programs that someone can use, they can use all 4 or 5 programs, not just one. So we got awarded for being able to help home buyers take advantage of multiple different programs. So you want to shop around. Rates are there, right? They're in the marketplace, but there are programs out there that can beat what the market rate is. Again, Liberty Bank has a product where you get a discount. There's programs for people with disabilities that offer discounted rates. There's programs for people who are first generation homeowners. There's programs for teachers. There's advantages if you buy in high opportunity areas. So there's just so much out there. So I think it's important to shop around to see what you may or may not be missing out on.
Let me ask a couple questions that are in the chat, Rashia, since they
Yeah.
directly relate to what you just said about Liberty Bank's 100% financing. Are there income limits restrictions for the 100% financing for the first-time buyers?
No, there's no income limit restrictions at all.
And
Um,
do you still have to pay PMI insurance?
Depending on how much you put down. So the program offers up to 10% financing, no PMI. If you're over 90%, which would be less than 10% down, then you would have to pay PMI. I hope that makes sense. So if you take full advantage and you take advantage of the full 10% credit, then there's no PMI. It's paid for by the bank. Not everyone may want to do that. Maybe they have their own down payment and they just want to add a little bit more, or they don't want to, have a $30,000 or $40,000 down payment loan. So it's all personal preference. Were there other questions?
There's one other question. It's a little off topic, but do you know how much we will have to pay realtors in 2024? Buyers didn't have to pay previously.
So that's not so there's a lot of confusion with the new bill that is being passed. Realtors always got paid. The sellers sometimes, and the selling agent would split the cost with the buying agent, right? It has always been an option to have the buyers pay for it. So nothing's really changing. I think it's more so an awareness about the process and what happens behind the scenes rather than there being a change. So just because a buyer can pay the fees doesn't mean that they have to. And I will say for people who are first-time home buyers, that could be difficult because, again, you may already be getting some type of assistance. So maybe let's just say you're getting the time to own $25,000. Now a portion of that has to go towards paying an agent. So it's going to hurt, those people who are taking advantage of the programs the most. I hope that makes sense.
Thank you.
You're welcome. All right. So next I want to talk about your actual mortgage payment. This is the most important topic because this is the monthly amount you will have to pay over the next 20, 30 years. And whenever buyers work with me, clients work with me, it's always critical to run the numbers for specific properties that you're looking at. A $340,000 house is not the same in each city, even each part of a specific town. Let's just say Bloomfield, right? Taxes vary. So as you can see from this chart, your principal and interest will remain the same because most first-time home buyers will get a fixed 30-year mortgage. However, your taxes and your insurance can vary. So it's important when you're running your numbers, you may get a pre-qualification letter from me or another lender, and we say, yep, you qualify for a $300,000 house. And I'm seeing taxes in certain areas are rising. Let's just look at East Hartford, for example. 7,300, 7,800, which is insane, right? So I may have qualified you at $300,000 on $5,000 taxes or $6,000 taxes. Now you're going shopping around, you find a home in East Hartford, taxes are 7,300. You no longer qualify for that $300,000 house. So you always want to make sure that you're presenting scenarios to your mortgage loan officer. So there's no surprises at the end. You want to make sure that if you put an offer on that house, that offer gets accepted, you still qualify for it. And again, insurance can go up or down. So principal, interest, taxes, insurance make up your mortgage payment.
Question. Alternatively, can people pay their insurance and taxes directly to the town and company versus escrow and having that monthly payment?
So most programs, and again, I'm not sure everyone who is on here, if they're a first-time home buyer, I keep referencing it. But
Yeah, we have at least a couple of first-time home buyers on this.
yeah, most of those programs require you to escrow it. Our Good Neighbor program, the taxes are escrowed, but the insurance isn't. So it really depends on which program. But again, if you're a first-time home buyer, most likely your taxes and insurance will be escrowed. All right. So I briefly spoke about available programs, down payment assistance, and I really want to break down the difference between down payment and closing costs. So your down payment is a percentage of the sales price of the home that you have to put down. A lot of times it's 3% if it's conventional, or 3.5% if you're doing a FHA product, right? So you think about that 3% of whatever that home value is that you're searching in, whether it's a $250,000 house or $450,000 house. You want to keep in mind, I need 3 or 3.5% down. There are programs that will help you cover just that 3.5%. And there's other programs. One of the huge programs that we work with that is so valuable to our clients is called HDF. They offer 25% down. So what you're able to get is that down payment plus more, right? So you're walking into that home with additional equity because you've paid down so much. So you get up to 25%. Again, it's a loan. None of these programs are free money. Sometimes we call them grants, but it's forgivable money or a loan. So that program has loans, and they also have forgivable grants, 0%. Forgivable grants, like the time to own program that Chaffa offers, is forgivable over a period of time. Closing costs. Closing costs is totally separate from your down payment. And these are all pretty much the fees associated with servicing your servicing your loan, right? Your attorney fees, your title search fees, taxes, right? You'll have to pay a portion of taxes. You'll have to pay your insurance up front. So those fees can also be 2 to 3% of the value of your home. And again, there's programs that can cover that. So that 25% down, you can break it down and add a portion to your down payment, and you can add a portion towards your closing costs. What I see now, you're ranging between $7,000 to $10,000 in closing costs. And again, that's at an average price home up to about $350,000. Obviously, the higher the home cost, the higher your closing costs will be. Your appraisal is factored into that cost as well. So that's the main point. Your down payment and your closing costs are two totally separate fees. I already mentioned there's programs for people in specific professions like teachers. Chapel offers a rate discount if you're a teacher. There's programs if you live where you work. Let's just say I work in Bloomfield and I'm buying a house in Bloomfield. There's grant opportunities available for you. And there's just so much. If anyone would like to learn more about those, you can reach out to me directly. Next, after you've gotten your pre-qualification, so you got all your documents together, you sat down with a loan officer, you know how much you qualify for. Now it's time to put your team together, right? I'm only one piece of the pie. Mortgage loan officers are only one piece of the pie. You want to make sure that you have a realtor. Your realtor is going to help you shop around for a home. You need to have an inspector. You need to have an attorney, and that doesn't mean that you have to go out and find these people yourselves, but just know that this is a dream team that's going to help you go from pre-qual to getting the keys to your new home, right? An attorney, who else? Your inspector, your loan officer, your realtor, and I think that's about it. So we have a list of folks. Your realtor may have referrals for you. So again, it's not like you have to go out and find these people on your own. And then all the fun starts, right? You've got pre-qualified, you know how much you can afford. Now you can find a home that fits your needs. After you start shopping around, you want to make an offer. You want to negotiate that offer. Some programs do require that you get an inspection, more so for an FYI, and then you close. So that was very high level. Again, today we focused mainly on the financing part, but now I want to open it up to any comments or questions you have.
Let me stop the record. Oh, almost hit the wrong button.